Let's do some prognostications here on the interest rates. First of all, what's your opinion? I think I probably know it, but Fed's talking about moving rates. Probably three times, maybe four, but probably three times this year. How does that impact? How does that affect mortgage rates for especially the non banker real estate agent? How does that impact the mortgage rates? What should they expect?
Well, I'm not in Washington. I'm not in office. I'm not a politician, and I'm not with the Federal Reserve. But here's what I think. with all those disclaimers, here's
Right.
what I think. Number one, I think that we'll call it the government, the Fed, sees inflation as a problem. So we've got inflation in a variety of core areas like food and gasoline. So how do we solve that? Well, we call home price increases appreciation.
Right.
Wow, that's great. Home prices, if you own a home.
Yeah.
If you don't own a home, it's a problem. If you do own a home, it's great. Price of my home's going up. I'm getting great appreciation. The Fed sees that as inflation. And housing right now, the price of a home is probably the single biggest inflation factor in this country.
Right.
So I predicted this months ago. There's no question anybody in my industry saw it coming. The Fed is going to keep pushing up rates. They have to.
Right.
They have to do that. They have to slow down this market, the housing market. But here's what they're missing. You want to know what they're missing?
What?
This situation has never existed before. And because they're not in real estate, I don't think they're seeing something. You see, what normally would be the case is if you crank up interest rates, that lowers demand. Lowering demand is going to temper inflation in houses. In other words, homes won't shoot up as quickly in value. That's the simple equation, always worked in the past. I don't think it's going to work this time.
Why is that?
Let me tell you why. Because they'll crank up interest rates. So what will happen is as they crank up rates, nobody's going to want to sell, because nobody who's got a 2.8% loan on their home is going to want to take one out at 5 or at 6.
Right.
And so when I say nobody, only people who just have to sell because they're get a job transfer or something are going to sell. So while the Fed will temper demand, sure, get it. What they're also going to do is make homes less affordable. So that's a problem. And the other thing is they're going to keep people from selling. And if they lower supply while they're lowering demand, all they do is raise the cost to own a home for those that have to sell and have to buy. And I think that's what's going to happen. I actually think the move to raise interest rates is going to backfire. And I think they're going to look back in a year and they're going to see that it did not decrease the appreciation or inflation in homes.
That's very, very interesting. It's a very interesting discussion. Mitch, what are your thoughts on the interest rate environment and the ultimate impact?
Yeah, so as we know, the Feds are going to be meeting up in March, and they're saying that they're going to increase rates. So, that rate could be anywhere from 1/4 to 0.5%. Now, this is on prime, right? And they're saying maybe 3 to 7 times over the next year. But what people don't realize is prime rate doesn't actually have a direct impact on mortgage rates. The way mortgage rates are based off of is the 10-year Treasury. So just to give you an idea, the 10-year Treasury today is 1.8%. Back in 2020, it was as low as 0.6%. And that's when you have the really low rates on mortgages. So do I see mortgage rates really fluctuating or increasing a huge amount? I don't. You just look at the inflation rate and the 10-year Treasury. It really didn't. It did fluctuate, but it really didn't fluctuate that big of an amount where it adjusted rate. And I don't foresee that happening again this year. As Greg had mentioned, the other factors that are all involved there. So, yeah, maybe we're in the low 4s. But back in 2008, when we had that last crash, we were at 4% back then. We survived, and everybody, thought that was the highest rates back then. Well, no, guess what? Back in the 80s, the rates were as high as 16 to 18%. So, but inflation at that time was what 14%, the highest it's ever been in the history. So we're at 7%. We'll see if we can get that down. But yeah, I think we'll see an adjustment, but it's not going to be a huge adjustment that's going to cause people to say, "Yeah, I just can't buy a house. I can't afford it."
Well, those are great points, and your points really make, I think, Greg's points that that with the rate increase, we've seen probably close to 150-ish basis point increase in the last 12 to 14, 15 months, and it's not slowing down. So, due to those other drivers, full disclosure. None of the three of us are economists. We don't work for the Fed. We don't impact Fed funds rate, but it's interesting to kind of see how that ties to the mortgage rates. I think that's a big question for a lot of folks is, okay, the Fed's talked about bumping this Fed funds rate. How does that impact, the 10-year, or what is the mortgage rates based off of? So, Mitch, I think that was some very nice discussion and description.